Okay, so basically, a true delayed financing is that there is no existing lien on the property. But the delayed financing tool it is very useful, and you just got to document from the start, paper trail. And that's the key of it. Now, remember, if you pull a HELOC on another property, that's going to be calculated into your debt to income ratios on the conventional side.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Bo Eckstein.
Hello, and welcome to another episode of the Investor Financing Podcast. I'm your host, Bo Eckstein, and today we're going to actually revisit delayed financing for real estate investors. Oftentimes, investors have to move quickly, and they want to purchase with all cash. But most often than not, they want to purchase with the hard money loan and then refinance into a conventional loan because they still have bandwidth. Maybe they only own a couple properties in their name, right? Because there's Fannie Mae caps how many rental properties you can have in your name. So I get this question often regarding delayed financing, and although I'm not an expert on Fannie Mae guidelines, I kind of want to talk about what a true delayed financing structure is. And for a true delayed financing structure, the original purchase transaction is documented by a settlement statement, which confirms that no mortgage financing was used to obtain the subject property. A recorded trustee deed or similar alternative confirming the amount paid by the grantee or trustee may be substituted for a settlement statement if a settlement statement was not provided to the purchaser at time of sale.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Are you in the market for a commercial loan? Did you find the perfect opportunity but need funding? Have a special situation? At Find the Bank, you will get quotes with competitive rates and terms from multiple lenders without any hassles. Have a multifamily property, construction project, owner-user property, industrial, mixed use, hotel? At Find the Bank, you can get nearly any kind of commercial financing. The process is simple. Once you send us some information about you and your property, we send back a quote sheet. Then we quickly connect you with an advisor. You won't spend hours calling multiple banks trying to find the right person to talk to. We'll connect you fast to the right person, hassle-free. Better terms than you could get on your own. Go to findthebank.com and complete the form. An advisor will be connected with you within minutes to discuss your specific financing needs.
Okay, so basically, a true delayed financing is that there is no existing lien on the property. There is hybrid models of delayed financing. So you're able to document, you can use hard money, and then especially if you're doing improvements to the property, right? So what you want to do is you want to, one is there's an alternative where there's a hard money lender that will essentially on the closing statement fund 100%, although you do put a deposit in escrow, your normal 15 or 20% or 10% down, but that sits in the escrow. The hard money fund funds 100%. It's all itemized on the initial closing statement when you buy the property, then you rehab. And the point is then you can document your costs for the takeout when you go and refinance with a conventional loan. It makes it easier because you have to document all the capital infusion. And typically on these conventional loans, you're not going to be able to get more than the total amount of capital that has been put in. The new loan amount can be no more than actual documented amount of the borrower's initial investment in purchasing the property, plus financing of closing costs, prepaid fees, and points on the new mortgage loan, subject to the maximum LTV, CLTV, and HCLTV ratios for the cash out. Transaction based on the current appraised value. These are all other cash out refinance eligibility requirements are met. Cash out pricing is applicable. So they're still going to price it with a slight hit for cash out on conventional. But sometimes you're doing a combination. Maybe you're pulling from a HELOC on another property. So you have to document that. The sources of funds for the purchase transaction are documented, such as bank statements, personal loan documents, or a HELOC on another property. You have to document and paper trail all of this. Anyhow, funds received as gifts and used to purchase a property may not be reimbursed with proceeds of a new mortgage. You can bypass all this by doing portfolio rental loans from the start. Rates aren't as good, but they're pretty darn good. They're in the fours, low fours right now, starting in the low fours. Actually, I just saw the rates even dropped into the high threes. So there's possibility, but that's at a lower 60% loan to value. But the delayed financing tool, it is very useful. And you just got to document from the start and paper trail. And that's the key of it. And then usually it's about a 6-month window they allow for delayed financing. But in theory, most lenders will let you use new appraised value after 6 months anyways. So depending on if you're closing all cash or you're actually closing with hard money or you're pulling a HELOC. Now remember, if you pull a HELOC on another property, that's going to be calculated into your debt to income ratios on the conventional side. So anyways, I hope this was somewhat useful for you. I'm getting a lot of calls lately from borrowers looking to do delayed financing. And probably what I'll do is I'll try to get a Fannie Mae underwriter to really pick their brains and dive in a little bit deeper on all the caveats regarding delayed financing. Hope this helps. Thanks for watching, and I'll see you on the next episode.